Hi and welcome to Fitness and Finance. This week we've got some questions. What's the right home loan for you and how do you go about deciding that? There's some options available to you. The first one's looking at a fixed rate. Now fixed rate means you're just going in, you're locking it in at a set rate for the next 2 years, 5 years, 10 years. Means you know what the regular repayments are going to be for that term that you've set it to. It does have some limitations. You can't contribute a lot of extra cash if you've got it at a fixed rate. But most lenders will have a little bit of movement, up to maybe 5% thereabouts. But it might only be $20,000 over a 2-year period, for example. So there's lots of restrictions depending on your lender when you're on a fixed rate on how much you can contribute. And whether, if you do pay that little bit extra, whether you're allowed to redraw it or not. So when you're looking at a fixed rate, it's more just for the regularity that you know what it's going to be and you're happy to go down that path. Next one's looking at a variable. Now look, variable rate definitely comes through with a lot of benefits. If I'm sitting there and looking at a variable rate, it means I can contribute extra cash onto it anytime I want to. If I get an inheritance next week, I can go pay it off tomorrow. So that's great. But if I'm getting that little bit of extra cash, then I'm going to be continuing to pay off that variable home loan sooner rather than later, which means I will get charged a little bit less interest rate because I'm paying it back sooner than, say, the 30-year period that we've set to pay the loan off in. Negatives going through with the variable rate: if the interest rates go up, so does yours. So you've got to factor that in if you're sitting there with a variable. Now, the other option on going ahead would be to do a split loan. The advantage of doing a split loan is we would do a portion of it as a fixed rate and a portion of it as a variable rate. Now, would you do that? Would you do it a 50-50? Would you do it as an 80-20? Again, that's up to you, and it sort of comes down to how long are you fixing it for and how much extra you think you're going to be able to contribute on a yearly basis over that time. So for example, if it's a 5-year period and you sat there and looked at it, then maybe we're better off doing a 50-50. Maybe you can foresee in the next 5 years your salary is going to increase, you're going to be able to pay it off quicker, so a 50-50 might be the right option. On the other hand, maybe we're only fixing it for a 2-year period. And if we do a calculation over on that 2-year period, maybe 20% would be the max extra you could ever foresee yourself paying. And if you ever manage to go beyond that, then it's worth paying the extra to pay it off. Maybe that's the way that we would look at it. So I need to assess your situation to decide whether we're going something like 50-50 and 80-20 or somewhere in between and varying it. Next, we're looking at interest only. Now look, interest only, I've got to say, these days is hard to get. Especially if it's your primary place of residency. They're expecting you to pay it off and pay it off sooner rather than later. So they've got to do a lot of justification if we're doing an interest-only loan. Now, look, majority of the cases that we do an interest-only loan is if it's an investment. So for example, if you've got your home loan and you're still paying that off, but you bought another investment property, then your main priority is to go and pay off your home loan first before the investment. From a tax point of view, there are possible benefits in there. So taking that all into account, that's when we're going interest only. Yeah, great in certain circumstances, but need to evaluate your situation. And especially if it's an investment property and you're still paying off your home loan, then it might be doable and worth looking into for your situation. Low doc loans. Look, low doc loans, we're doing less of those these days than we have in the past. Low docs are great in that we don't need as much information to make sure you're right to get the loan, but the interest rates on a low doc are going to be higher. So when those interest rates are a little bit higher, you've got to sort of be able to see that there's a benefit in that. Maybe it's usually a self-employed person. The tax agents are doing a fantastic job in making you pay a whole lot less tax, but you've got to get the house, the home loan now, based on last year's tax return, when the accountant had done a fantastic job at making sure you weren't paying too much tax. So that's where we get an advantage with going through a low doc. Generally, if you can wait and we can get the paperwork in order to actually do a full doc loan, then you're going to get a better rate. So again, If you need some help, if you've got some questions about figuring out which one's right for you, happy to have a chat with you. Give us a call and we can go over your situation and start identifying what's going to work for your scenario. Have a great week and we'll talk to you soon. Thanks.